welcome to Bondcast. I'm Imogen Bachra and I'm joined today by our global market specialists Ian VanderHorn and Giovanni Zanni. We're recording this on Thursday after a central bank bonanza, I think it's fair to call this week. We've had policy decisions from all of the major central banks, not limited to, but of course what we will be discussing today, the Bank of England, the Federal Reserve and the European Central Bank. I'm obviously biased, but I think it's an objective statement to say that it's the Bank of England that has moved the market the most of those three major central banks. So it probably makes sense to start there and just to have a quick think about what they told us today and what that means for our market views. Anybody who's been watching the market today will know that the market interpreted what the Bank of England told us as a very hawkish reaction shift. We had no change in the policy rate, but a 9-0 vote to keep rates unchanged, which was a little bit more hawkish than probably consensus was going in. I think there were a couple of calls that some votes for rate cuts from the most dovish members, which wasn't what materialized. I think markets were right to interpret what the Bank of England told us today as somewhat hawkish. There was a clear shift in their reaction function from the direction of travel being towards lower rates to rate hikes now being on the table. What I would push back against in the way that the market interpreted the Bank of England's reaction shift is not the direction of travel, but probably the timing of those potential rate hikes. And what I mean by that is that even amongst the most hawkish MPC members, there was a clear need for evidence of persistence of this inflationary shock and evidence that there are second round effects, which would be problematic for an inflation targeting central bank. Yet the market has now fully priced a 25 basis point rate hike by June. At the time of recording, it has about a 50-50 chance of a rate hike by April and a full one by June. Now that feels very premature, especially when we think about the UK and the data that we're going to get ahead of that June meeting. The next energy price cap, which sees a reduction in energy prices, will be in place until the May meeting. So they will have 1 month of data by the June meeting that might reflect higher energy prices. Arguably, that is not nearly enough to conclude whether there are persistent second round effects of this upside shock to inflation. It's not necessarily about the way in which the market interpreted the direction of travel or even necessarily the peak kind of level of rates from here. I think the market at the time of recording has peak rates at just above 4.25. So it's got about 2.5 rate hikes in from here by the early part of next year. That seems a little bit hawkish, but not outside the realm of possibility. Whereas the idea that we're going to get at least a full rate hike by June does feel a little bit premature. We have updated our rate view. Regular listeners will know that we had been expecting rate cuts, at least until this rise in geopolitical tensions over the last couple of weeks and the conflict in the Middle East. That clearly seems out of the question now. But it's like I say, it's not obvious to us that we get rate hikes as soon as the middle of the year. In fact, we're thinking that Q4 is perhaps the more likely timing for any rate rises. It's possible that they're a little bit earlier, the back end of Q3, in which case you might get more than one rate rise this year. But as it stands, we've revised our projections to see just one rate rise. We've taken out the cut and we have added in a rate hike into the end of the year. So we are sort of in line with market pricing when it comes to the potential level of rates that we could get to, but it's very much about that timing element that we push back against on market pricing. For our gilt yield view, of course, had to tweak those numbers slightly. We've pushed up the level of fair value of kind of front end rates. If we look at the 2-year part of the curve, we previously thought that fair value was probably around 3.8%. I've pushed that up slightly. We're now looking for something closer to 4.2%. And at the longer end of the curve, I think we spoke last week about how we saw 4.8% as the kind of fair value level for 10-year gilts, but we saw upside risks to that view. Since we spoke about that, we've sort of touched a couple of times and now broken through that 4.8% on a more sustained basis in 10-year gilts. And again, I've revised up that sort of fair value projection to 5% in 10-year, which doesn't seem significantly higher than where we are now. But it's a combination of the fact that one of the upside risks to our view has crystallized, and that's a sort of reaction function shift from the Bank of England, but also a long-held driver of that bearish view around fiscal policy and the extent to which the market is continually underpricing the fiscal sustainability risks to the UK. I think has become heightened over the last couple of weeks. I think markets are right to be concerned about the inflation impact of the conflict in the Middle East, but it's still surprising to me that there is what I would consider to be a lack of concern around the potential fiscal impacts from this conflict as well. And they're sort of two-pronged. You have the pressures on defense spending, but you also have the potential, the longer that this conflict persists and the higher energy prices persist, the potential for government intervention to limit the impact of those higher energy prices on households and on businesses. And for a government that already sailing pretty close to the wind when it came to fiscal sustainability, higher spending pressures against a backdrop of also higher interest rates is a kind of unwelcome combination. And I think that markets would be wise to be more concerned around that fiscal outlook in the UK. So slight upward revision to our yield views. And of course, with it, we retain a steepening bias on the curve, but perhaps that's just moderated slightly versus where we were even just last week, for example. Given that there is so much to discuss with other central banks, Gio, we're recording this on Thursday, so perhaps it makes sense to pass over to you, where we've also just had the ECB rate decision, and unlike the BOE, we also had a press conference and an updated set of projections from them. So do you want to talk us through your take on what we learned from the ECB today?
I would say that the main message from Lagarde today was one of measure, of calm. She was not pushing in the direction of immediate action. She said that inflation expectation remain well anchored so far, and that the ECB is definitely in a better position than where the ECB was in 2022. For that reason, I would say that the first moment to really assess the situation in terms of deciding or not to act is June rather than the April meeting. Of course, if you look at the baseline that was updated up to the 11th of March, which is already better than what you would have expected, because otherwise it would have been at the end of February. But still, that baseline looks a bit obsolete given the developments that have taken place over the past week. But it's also true that things are highly uncertain, and so things can change again. So I would not take the baseline as a completely wrong scenario. There were alternative scenarios as well, including one which is more adverse in terms of impacts, and another one which is more persistent in terms of impact. But in all these scenarios, the main thing will be the duration of the shock and the impact on core inflation through second round effects. And on that, I think that Lagarde was very clear in saying that they will look at surveys, especially selling price pressure. Of course, they will look at inflation expectation embedded in financial indicators such as inflation break-evens and other measure of inflation expectation, for example, from households, and also more generally other business surveys. So again, all this pushes towards something that tells you June rather than April for a decision. And I think that this is really what was the message from the ECB today, also reinforced by the idea that there was an unanimous decision. Our central view is that if things come down by that time, by the June meeting, there will be no strong reason to hike rates. But of course, we are, like everybody else, waiting for events and in a highly uncertain situation.
Thanks, Gio. Ian, I will pass over to you. I think the Fed was perhaps the most surprising in some ways, although it sort of led to not the biggest market reaction over the last 48 hours, but the most surprising in the sense that they seemed to dismiss the impact of the conflict on their reaction function and outlook. Yet the market still interpreted what Powell told us as relatively hawkishly, but I think that was perhaps more about his comments on his role as Fed chair and his role on the board, rather than an updated assessment of what the conflict means for their inflation projections and potential rate path. So do you want to just talk us through your sort of take on the Fed and how that compares to current market pricing?
Yeah, absolutely. Thank you, Imogen. I think you're exactly right. I wouldn't necessarily say dismiss the conflict in Iran, but they really seem to take all measures possible to really acknowledge it as little as possible. And that was really what I think was surprising from my perspective. So with respect to the decision in the statement, the only really mention of the conflict in Iran was that it presented risks to both sides of their mandate. But that was it. They acknowledged it. They said it presented risks, but they didn't really mention which side of their dual mandate it presented risks to. And that was interesting because just from the onset, it sort of softened, I think, the expectations for how much the Fed was going to weave in the conflict and the associated energy shocks into this meeting. So from there on, I think the balance of the delivered materials, this was a summary of economic projections forecast meeting, which included the dot plot. I think it fell a little bit on the hawkish side of expectations coming into the meeting. The median member in their dot expects just one cut in 2026, one cut in 2027. That's unchanged. And then the long-term neutral rate dot was actually revised higher. I will also mention we didn't quite have the dissents we expected at this meeting. We only had one dissent in favor of a policy rate cut, and that was Mirren. We didn't have Governor Waller dissenting, nor did we have Bowman. So perhaps just one less dove than we were looking for at this meeting. So between the dot plot moving a little bit more hawkish and just one dissent instead of two, perhaps a hawkish read just in terms of the delivered materials from the Fed at this meeting. But in my view, at least, around the forward guidance, at least around the rate trajectory that the Fed sort of gives us, that was really the extent of what markets could have, or in my view, should have grabbed onto as hawkish at this meeting. I think it's notable that Powell in the press conference really emphasized just how uncertain this period was. He discounted the latest set of forecasts. He even sort of made a joke about them potentially skipping the summary of economic projections at this meeting just because of how pervasive the uncertainty around the conflict is. But he also talked a lot about his expectation around inflation, mostly that he expects inflation in core goods to continue to fall as the one-time impacts from tariffs get cycled out. And he really spent a lot of time talking about tariffs and talking about the inflation getting passed through in coming months. It's interesting because he spent the meeting that could have been spent discussing the threat from higher energy prices to inflation, instead talking about how tariff pass-through is transitory in his view. He really doubled down on this notion of transitory pass-through of prices, which at this meeting I think was something that stood out to me. He also spent some time talking about the labor market. Naturally, he really said that this labor market isn't really adding any jobs. It's pretty fragile. And the risks to the conflict in Iran, to inflation and to growth, they're really two-sided. So I'll come back to now what you mentioned at the onset, which was the market reaction and the associated bear flattening we saw. And, we did see Fed repricing at this meeting. But it was really around Powell's comments around his future at the Fed, as you alluded to. He said that he would stay on as chair on an interim basis if a replacement wasn't confirmed by May. That's a nod to the fact that Kevin Warsh's nomination is being held up in the Senate right now by one Senate Republican, Tom Tillis. He also said that he would stay on the committee as long as the Department of Justice investigation into him was ongoing. So he said he would, definitively remain a committee member until that investigation was wrapped up. And third and finally, he also said that he, hasn't really decided on his future as a governor after his chair position is up. And he even sort of made a comment about doing what is best for the institution. And in my mind, that spoke to, potentially being, having a thought of institutional credibility in mind when he thinks about his future. So the market pricing in reaction to all of this, I think, was more about, pricing in more Powell for longer, if you will, and less Kevin Warsh, assuming Powell, has the opportunity to stay on past May into June, July, even later in the summer, however long the nomination is held up in the Senate. So I do think that's understandable, just, given our expectations for Warsh and our expectation that he is going to come in and try to drive dovish policy. But really what stood out to me here was that it does discount the Fed's current reaction function to inflation and growth that we see even under Powell and under this, current Fed. And I always come back to this, so I apologize if I'm repetitive, but inflation has been above target in the US now for 5 years. And this Fed has been managing towards growth, and they've been managing towards the jobs market. So if we think about the energy-based inflation shock that we're going through now with Iran, it does put upward pressure on headline inflation. Powell mentioned this, but he also mentioned the pass-through to core inflation should be more moderate and the risks to growth are there. So I think regardless of whether you price in more Powell or more, Warsh, the current Fed strategy and the current Fed models sort of speak to the same thing, which is you take this energy shock and you're supposed to look through it. You're supposed to look through it and you're supposed to focus instead on the impact to growth. And I know I already sort of discounted the dot plot and discounted the forecast that the Fed gave us, in part because Powell spent some time doing that same thing. But it is also worth noting that they do expect a cut this year, and they do expect a cut this year, at least on the median basis. So they're aware of the risks of this conflict, and they didn't make that hawkish step in the directions that markets did yesterday and certainly today. So I guess I'd say with respect to treasuries, this is all to say I'm a little bit confused just about the scale of the bearish market reaction. We've seen a follow-on this morning as well. I know that's partially due to escalations in the Middle East, partially some carryover, likely from the BOE. But it just doesn't necessarily feel right to me to price out as much of Fed easing as we have. If I just look at swaps markets right now, they're really only pricing 5 basis points of easing before year end. So I call that, no Fed action at all this year. And looking further out, that first cut isn't even priced until, end of 2027, really. So we've pushed the timeline for the Fed to make its next move out a full year. Granted, we aren't pricing in hikes, but we've pushed out the timeline by a full year just in a matter of, a couple of weeks, most of that having happened in the last 2 days, though. So I'm also looking at the front end of the Treasury curve, the 20-year note. It's trading about 20 basis points above the rate that the Fed pays on bank reserves. That's excessive in my eyes. That speaks to the Fed's next move being a hike. I know we're not seeing it in swaps or futures markets, but that's really what that says. And I would just remind here that we're really only one bad labor market report, similar to what we saw in February, away from markets probably pricing this all the way, back in. If we get another negative print for March, in a couple of weeks, if we see some upward drift in the unemployment rate, I think these expectations for the Fed get pulled right back forward, back into this year, sort of irregardless, or sort of regardless rather, of inflation above target. And I think the front end, on that sort of labor market risk could have some scope to reprice here. I do think the Fed continues to be more focused on the growth impact than inflation. I do continue to think that inflation around, high 2s to 3% is less of a worry than the unemployment rate drifting up. So I really think markets should sort of keep that in mind. This is a growth-focused Fed. The shock from Iran carries two risks. It carries a risk to inflation and it carries a risk to growth. And at least in our eyes right now, the markets are really overweighting that risk to near-term and long-term inflation. And we should just keep in mind that the U.S. is not on as strong a footing as it was, in past energy shock episodes, I think 2022. And our labor market is just really not adding many jobs right now. So the risks are pervasive, and we think the Fed will keep that in mind going forward.
Thank you, Ian. That's perfect. So quite a few different house views there that differ, I suppose, to where we see current market pricing and the direction of travel. But time will tell. That's probably enough for this week. Lots of headline tenors. Of course, the major focus was all of the central bank meetings, and I think we've covered those nicely. So we will end there this week. Thank you to our listeners for listening in. Thank you to you both for joining me. Just a reminder that if you liked today's episode, please don't forget to click the like button and hit subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.